doing a tutorial on groups as per IFRS for SMEs. But first we need to wrap our head around some terminology. First we need to define a parent. A parent is the acquirer. They take control of the subsidiary. In this sense, control is seen as the ability to govern the financial operations and financial and operating policies of a business in order to obtain benefits. In order for these benefits to be obtained, there needs to be a subsidiary, and subsidiary is basically the entity that is being controlled and is seen as the acquiree.
Through this process, the parent acquires the subsidiary, and it's called a business combination. It's the bringing together of the parent and the subsidiary. The name that's given to this consolidated entity is called a group. And so we're going to be doing the first question. I'll just read that out first before we answer it. A consolidated statement of financial position should have all the assets and liabilities of the parent and subsidiary company included on it. Why is the $4,050,000 cost of investment in the subsidiary not included in the consolidated statement of financial position? So in making this business combination possible, we draw up something called the consolidated financial statements, and this is basically just the adding up of the assets and liabilities of both the parent and the subsidiary, and it represents the distribution of the investment in the subsidiary company over to the parent company.
For this reason, an entity will eliminate the carrying amount of the parent's investment in the subsidiary when preparing consolidated financial statement as per section 9.13b of IFRS for SMEs. This is done to avoid double counting. Thank you.
Hello, I'll be explaining part C of the question, which basically asks us why in the group financial statements the land is recognized at 33,050,000 rand. Okay, so when a parent buys the net assets of a subsidiary, these net assets need to be recognized at fair value. And this fair value represents the cost that the parent is actually going to pay for them. So the 33,000 and 50,000 represents the fairly valued land which the parent is now obtaining, and so this is the cost to the group. So the group as a whole paid 33,050,000 rand, and that is why the 33,050,000 rand is recognized on the group financial statements and not the 30 million.
Okay, good day. My section I'll be covering is goodwill. But firstly, what is goodwill? According to IFRS for SMEs, goodwill is the future economic benefits arising from assets that can't be identifiable and separately recognized in the financial statements. Goodwill is internally generated and doesn't appear in the subsidiary or parent's financial statements. Then, why doesn't the goodwill appear in the separate financial statements? Goodwill is only recognized when the parent controls the subsidiary and pays the purchase price above the net asset value of the subsidiary. The subsidiary doesn't recognize goodwill because it is internally generated and cannot be reliably measured. The parent doesn't recognize goodwill because it is from the group's perspective, and the group owns the net assets of the subsidiary, which includes any unidentifiable assets, thus being goodwill. Thank you.
Hi, I'm Matt. I need to explain to you what goodwill is. I'm not going to show you how to calculate it. Basically, the first thing is to take the fair value of consideration paid, which is the investment by the parent, over here, XXX, and then we need to look at the fair value of the net assets acquired. And to get this number, we look at the book value of the net assets on the subsidiary's books, and then add or subtract any fair value adjustments made to it. This gives us the total over there, and the difference between these when it's positive is recognized as goodwill by the parent.
Question D is the parent company's separate statement of financial position has a liability loan from a subsidiary. Why is that liability not on the consolidated statement of financial position? So basically, if you look over here at our statement of financial position, from the group's perspective, there's no loan, and the parent company's separate statement shows a loan of 350,000 rand. So what's happened is the subsidiary in the group has loaned money to the parent, which has resulted in a liability. And if we look at our liability definition on page 14 of IFRS for SMEs, you'll see that there are 3 requirements for it to meet the definition of a liability. First of all, it has to be a present obligation. So from the parent and the subsidiary's perspective, as individuals, the parent has a present obligation because they have to repay the money due to a past event, which is the second criteria, which would be the signing of a loan, or the payment of the loan from the subsidiary to the parent. And the third requirement is that it has to result in an outflow of economic resources embodying economic benefits. So from their perspective, they have a loan and it meets the criteria. However, from a group perspective, they don't have a liability, and the reason for this is it doesn't meet the definition according to IFRS for SMEs, because from their perspective, they don't have, first of all, they don't have a present obligation, because they don't, from a group perspective, they don't have to do anything. It's happening intercompany, and the main reason why it doesn't meet the criteria is that there's going to be no outflow of economic resources from the group as a whole. If you have a look at the group as a whole, you have company A, company B, and money is going from company A to company B in terms of the loan, and then back, so on. But from a group perspective, nothing has left the group. So the reason why it's not shown on the statement of financial position as a loan for the group is because it doesn't meet the definition. So just to quickly explain why it's not there further, if you look over here, to explain it, this is a subsidiary, this is the parent, and that's the group at the end. So that's where they want it to be, and this is where we are now. This is the loan, this is the money going in and out of the bank, so they're separate companies, and this is the receivable. So from the subsidiary's perspective, they've taken 350,000 rand out of their bank, and they have a receivable from the parent company, an asset of 350,000. From the parent's perspective, they have a liability of 350,000, and they have 350,000 rand in their bank. So it works out to zero on both sides. But if you add it up this way, suddenly you're saying that the group has a loan as well as 350,000 in the bank, so they cancel out. So what's happened is they've done a pro forma adjustment to cancel out the loan and to cancel out the receivable that the subsidiary has, which you can see over here. So you debit, this is a pro forma adjustment to reverse it, which is debiting the loan to decrease the loan liability, and crediting the asset, which is the receivable, and that cancels out, and that's why the group doesn't have a loan on a statement of financial position.